Hi folks, it's Rob Flux here from Property Developer Network, coming to you live for another Sunday session where this week we're going to be talking about the current market impacts on lending. Now, just before I do that, I just want to set up a couple of things in the background on my Zoom screen because otherwise I'm not going to be able to see your questions coming through. I learnt a very valuable lesson last week that sometimes you don't actually get to see what's going on if you don't know how to drive the technology. So trying to do that whilst I speak to you. So give me 2 secs while I set that up. And why is technology always beating me when I've got everybody watching? That's the challenging part. Okay, so going to give you a bit of a screen share and hopefully I'm going to see your questions coming through as we go. So as I said, current market impacts on lending is really the intent of today's chat. Now, in doing so, I'm going to give you a little bit of a market overview as to what has been happening around the grounds in and around the property world. But to do that, we need to understand a little bit about what's been happening in the COVID world. I guess that's impacting our lives on a daily basis at this point in time. So let's have a look at, I guess, the world that is COVID at this point in time. So market update. So firstly, I want to say, legal disclaimer, I don't have an AFSL license. Some of the things I'm going to be talking to here, I guess I don't want to be perceived to be giving you either general or specific advice. This is really educational purposes only. So you should always make sure that you seek professional advice on your own individual circumstances. So having said that, let's have a look at what is actually happening in COVID around the world. And as we can see, we're just nudging on 1.8 million cases, I guess, and of that, a little bit, just approaching 110,000 deaths and 404,000 recoveries, which is close to 22 odd% recovery rate, which is fantastic that people are getting into that phase of things. If we have a look at that, though, clearly North America, the curve is still climbing for those guys, and especially the United States. So they're still in a world of pain. My understanding is that last night they had the largest death rate on record so far, and that is still climbing. So you know, they're still not yet approaching the peak of the curve for these guys. Now, if we look at ourselves, though, 6,300 odd cases, 57 deaths, unfortunately. And again, we've got a very similar percentage recovery rate at 1,800. That's around that 22 to 25% mark. But what I want you to notice is down the bottom here, this little graph here, which is the daily increases in the number of cases, which is clearly showing a decline, which is fantastic from our side. If we have a look at us specifically and New Zealand as well, our curve is definitely flattening. And that's largely, I think, because of the fact that we're on an island, as is New Zealand, and we were able to lock the borders up pretty hard and get to this before it actually took hold quite seriously. So kudos to, I guess, the government, whichever side of the fence you sit on there. I guess all sides of the government were actually working cohesively together to try and make those things happen and actually start to lock us down very, very quickly. Now, if we have a look at the individual cases, again, this is having a look at the number of cases on a daily basis and also an accumulative basis. So we can see clearly that we're on the better side of the curve for all intensive purposes. Even though we still have cases climbing, we're certainly on the better side of things. And you'll notice that the local talk in some of the governments is, some of the state governments is, the rhetoric that they're talking about is the fact that, yes, we are on the better side of the curve, and they're talking about potentially doing what they call an on and off relaxation. So maybe we get to go out and do certain things, but still keep us locked down for other things. Still early days on that. I'm going to predict that in the next week or two, we're probably going to hear a lot more about what they will and won't allow us to do. So keep an eye on that, folks. Now, if we have a look at this in a little bit more detail on a state-by-state basis, we can pretty much see that flattening of the curve has happened in every single state. I guess the three largest states being New South Wales, Victoria and Queensland, every single one of them have flattened off, which is a fantastic outcome. So all credit to all jurisdictions in that regard. Now, let's have a look at what this has meant with regards to our stock market. Now, this is the All Ordinaries Index, recent as of yesterday. Sorry, the 9th, I should say. So it is a little bit behind, but being a weekend, they wouldn't have been trading anyway. And what you can see is that we had a significant drop, I guess, from the start of March, and it's bounced quite a long way down, but you see that we're actually in a little bit of a recovery phase. Now, the recovery phase, I'm not a stock market trader. I guess many moons ago I did attempt that, but this is one of those things where I think people are actually getting in because they see perceived value in the market. So they see where the stock market was a month or so ago. What they're seeing now is that the stock market is, significantly lower than that, and they're seeing good value in buying into that. And so that's causing a little bit of a recovery in our market. Similarly, if we look at the American market, the Dow Jones, seeing very similar instances. So again, it started to drop off just before March, has dropped down and is now starting a recovery cycle. Now, too early to actually tell right now whether this is a true recovery or this is just I guess one of those bumps that we have along the way where we're actually testing the market. Now, this is not my area of expertise, hence the disclaimer earlier on about the not having an AFSL license, because this isn't really where my expertise lies. However, what I'd like to point out is when we go back in history and have a look at some previous instances where we've had fairly significant drops in our market, and this is the All Ordinaries Index during the GFC, what you can see right here is the peak of the GFC, so just before it actually dropped, and you'll see that it did do a very quick drop and then a quick recovery. So what I'm cautious of right now, that this might be a similar sort of instance where yes, it's dropped off, then it's tried to recover, tried to rally. People are trying to see value, but unfortunately the run on the market overwhelms the number of people trying to do the recovery, and then it drops down. And you'll see that we actually tested the market a couple of times during that GFC and another one down here before it actually finally hit the bottom and then finally started to climb back. Now, in doing that, it's taken several years to get from the original peak back to that peak again, and even then it was only a momentary recovery at that point, and it kind of dropped away again. So it's depending upon I guess what side of the fence you're sitting on, it's arguable that we didn't actually get a full recovery from the GFC until very, very recently. So I guess one of those things to just be mindful of, that this drop in the market that has just happened, we're not quite sure whether or not that recovery is, one, recovering straight away, or two, whether this is actually testing the market and it may fall a little bit further. So we need to be very, very careful in the next week or two and month or so. If we look at the exact same thing on the Dow Jones, again during the GFC, now that was the peak of the GFC before the drop off. And at that point there, you can see again, it did a drop and a recovery, a drop and a recovery, another drop and a recovery. So it's tested the market several times before actually hitting the bottom. And again, has taken several years before it actually has come back. Now, in the instance of the Dow Jones, that's pushed through and recovered well and truly, but for our markets, that hasn't really recovered as strongly as we would have liked by way of comparison. So my caution to you guys is to say, right now, what we're seeing in the stock market, is that a recovery, or is that, I guess, just the market being tested, in which case we may have another drop. So be very cautious about any activities they're going to be doing in and around the market at this point in time. What I would say, though, is that the stock market is generally a lead indicator for the property market. So having said that, let's have a look. So this is previous recovery timelines during other crises that have happened over time. So we've got World War I all the way down the bottom. We've got World War II, We've got, for example, I guess the GFC that's sitting up in the 2008 mark. That's kind of all the way up here. And Y2K sitting in here. So there's a few things where we've actually had drops in the market, and generally they take several years to actually come back. So my caution is that if this really is what the world is talking about, then it may take several years to actually drop off. But let's see what our government has actually done to see if we can stave off some of this. And I guess too early to tell, but at least we can see what they're doing, why they're doing it, and we'll be able to actively keep an eye on what's actually happening. So one of the first things that is one of another indicator, lead indicator, is our unemployment rate. Now, down the bottom in the red and the blue, this is the seasonally adjusted unemployment rate according to the Australian Bureau of Statistics. But above that, in the kind of grey-green kind of colour, is the actual unemployment rate as captured by Roy Morgan Research. And what you'll see is it's significantly above the seasonally adjusted rate, and two, there's been a significant burst in the last little while, and it's bumped all the way up to this 16.8% unemployment rate, which, you know, that's a significant level of unemployment. Now, what I would like to point out on top of that is it's not just the fact that we've got 16.8% unemployment. It's actually, when we look at this graph, there's also a significant amount of underemployment. So underemployment is people where they are still employed, but their number of hours have been reduced and they're really doing the minimum just to keep the lights on at work. And there's a lot of people that are falling into that category where the job keeper stimulus packages have kept people employed. But they've been kept employed in an underemployment rate rather than an actual employment rate. So in this area here, 2.7%, sorry, let me say that again, 27.4%, where you've got a combination of unemployed and underemployed. So that said, very challenging times ahead, folks. Now, let's have a look at, by comparison, our Australian unemployment rate over history. Now, this is a graph that goes back, I guess, several odd years, so 30 odd years. Let's have a look at, this is the recession that we had to have in the 90s. So we can see there, that's about the 11% unemployment rate. Now, noting that we're at 16%, and or 27%, depending upon how you're actually wanting to measure it. We also had Y2K, and again, that's sitting around the 6.5% mark, and we also had the GFC around the 4.5% mark. So by comparison, our unemployment rate right now is in a world of pain, and so we want to be very, very careful that that the unemployment rate is going to have this cascading effect on our economy. And that's why the government has spent so much money on these stimulus packages that we've been hearing about. So let's have a look at that. So right now, this is a graph that came from CoreLogic during the week. So currently the unemployment rate is about 17%. What they're predicting, and I say it is a prediction, is that they're trying to get that unemployment rate down to around 9% by about the June mark. The intention there is if they can prop up business and keep people, even if they're partially employed, keep them actually working and keep businesses actually ticking over, then that's going to help the economy recover. Reason for that being is if small business can stay afloat and keep people employed, people actually then have money, they can then go out into other small businesses and spend that money and keep other businesses alive. That means that people can then, whilst they're receiving income, means that they can pay rent. If they're paying rent, that means that their landlords can receive income, which means that they can then pay their mortgages, and so then the banks stay afloat. And so keeping business alive is really the primary driver that the government's trying to go for right now for a range of different reasons. Now you can see on the graph on the right, this is the projection of GDP. So GDP is anticipated to drop in this current quarter, and hopefully that it will surge back, I guess, to the 5.2% mark by Q4, which I guess hopefully will mean that technically we don't trigger a recession, although I think that's going to be challenging to not trigger an actual recession. So a recession is negative GDP for 2 quarters in succession. So my hypothesis is that we will have a technical recession, but I guess there's a range of economists that are trying to say one way or the other as to whether or not the government stimulus packages are actually going to help that. So let's have a look at these government stimulus packages. So they have announced $320 billion. So this is the federal government through a range of initiatives. And most of these initiatives are really intended to try to keep business afloat. Okay, so there's a range of things. So there's wage subsidy packages, there's JobKeeper, there's JobSeeker, there's all sorts of funding to try and keep business going. There's 50% loan guarantees through an SME guarantee scheme and a number of others. So those are just for business. And then for households, there's also a number of other packages to try and keep households afloat. The whole concept being that if they can keep money circulating through the system, then that's going to keep businesses afloat, as I said, and businesses will then have this daisy chain effect of keeping everybody else afloat as we go. So fingers crossed that that actually works. Now, on top of the federal government doing things, each individual state is also doing things. So there's about $13 billion in state government stimuluses that have been promised around the grounds. And at this point, Queensland's at $4 billion, New South Wales at $3.3 billion, Victoria's at $1.7 billion. So it adds up very, very quickly, I guess, the amount of support that everybody's trying to give in this regard. Now, I'm not going to go through the individual stimulus packages for everyone, but this is a little bit of a summary of the different state-based stimulus packages so that everyone can go back and review a little bit later on and see what may or may not apply to you. Most of it, again, is sitting in and around the business side of things, although Queensland has been a little bit creative in some of the things that they've done with regards to actually doing rental assistance, which I anticipate some of the other states will probably follow in due course. Now, going back a couple of weeks, I showed this particular graph. This was how the world had been dealing with, I guess, rentals being paid and mortgage assistance to see what was happening at the time. So this graph was about, this table, I should say, was about 2 weeks ago. I predicted at the time that we were likely to get some assistance with mortgage repayments, with moratorium, and also that evictions would be suspended. I was optimistic that rents would also be frozen, but this is what actually happened. So the moratorium on mortgage repayments has come into effect. Now, how they've done that is slightly different for commercial tenants versus residential tenants, and I'll touch on that in a moment. And evictions have been suspended in both worlds, both commercial and residential as well, but there has been no rent freezes to date. So I guess a lot of the things that I was hypothesizing did actually come true. Whether or not that will be remediated over time and rent freezes and that sort of thing, I anticipate that there will be no requirement to put a rent freeze in, because the ability for people to actually pay more is going to be very challenging anyway in these difficult times. So any landlord who's putting rents up at the moment has probably got rocks in his head, to be brutally honest. So let's have a look at what they've done for commercial leasing, which has been slightly different for residential leasing. So about 5 days ago, the federal government released a code of conduct for, I guess, all the banks to abide by. And, sorry, not for the banks to abide by, for landlords to abide by, I should say. And in that code of conduct, the language was a little bit loose, to be brutally honest. So there was a lot of shoulds and some musts, but it's not actually legislation. It's just really a code of conduct. So it's really difficult to know at this point in time how much power it's actually got. However, I would say that most people are going to follow the lead that the government has actually proposed. So what they have said in there is that the landlords should reduce their rent by a percentage of the reduction in business turnover of their tenancy. Now, by that I mean, if your tenancy has been shut down, because of the fact that the coronavirus is impacting your business and you have 100% impact on your business, then you should have a lease reduction by 100%. If your business has slowed down by 30%, though, they're encouraging you to reduce your rent by only 30%. Having said that, of those reduction, what they're proposing is a minimum of 50% of that be waived in the way of rental costs. So that rental reduction should be by way of 50% is just written off, and the remainder of that is a deferral, and the deferral would be up to 12 months or the length of the lease, depending upon which is the greater. Now, that's, I guess, a little bit up for conjecture at the moment. The challenge is that there's no structure that sits around that with regards to, you know, legal stature and that sort of thing, and it's really a case-by-case basis with individual tenants talking to their landlord and trying to negotiate that, and how they actually demonstrate that loss of business is equally challenging. There's no mention of whether or not the rentals will be, you know, whether or not interest will be accumulated on those sorts of things either. So very interesting. So landlords are then encouraged to then go talk to their banks, with the banks to actually defer mortgage repayments on a case-by-case basis. And again, the banks have been encouraged to do those deferrals of at least 6 months. And I'll talk to in a moment how the banks have actually responded in and around that regard. Now, in order to make this happen, there's been some APRA lending restrictions that have actually been lifted. So the Australian Prudential Regulatory Authority are the people that actually manage the lending rules that sit in and around Australia. So there's some lending criteria that have been lifted there. Now, residential leases, this has actually been dealt with a little bit different. Now, reason being is that federal government doesn't actually have any jurisdiction here. So this is really a state-based approach. So it's not really uniform across the country. So the federal government has come across with a mandate saying that there will be a 6 months eviction ban. However, how that's actually enforced will be legislated differently by each individual state, because each state has its own legislative framework that sits in and around that, typically within the Residential Tenancies Act. So any evictions in that period cannot be based on any COVID-19 influence. Now, what that infers is that you can still do evictions if they are non-COVID-19 based, but it doesn't actually categorically say that one way or the other. It's kind of the inference. If you are a landlord, though, I would say that if you've got a tenant, whether they're a good tenant or a bad tenant, if they're in place and you're thinking about evicting them for any reason at all that is non-COVID related, you want to have a long, hard think about, well, whilst they might be a bad tenant, are they better than no tenant? And that's up to you to actually consider the implications of that on your own individual circumstances. Landlords, again, are encouraged to talk to banks to defer mortgage repayments on a case-by-case basis. Now, what I would say here is that in doing so, I guess tenants can actually come to you and actually say, look, I've got some hardship. I would like to either defer my rent or maybe pay less rent or those sorts of things. You want to be very, very, very careful here that if you renegotiate a lease arrangement or a rental repayment arrangement, you want to be very careful that if you have landlord's insurance that has, I guess, a rental protection mechanism in there, that if you renegotiate that rental payment, you may actually do yourself out of the income protection clause that you've got in there. So make sure if you've got any income protection in your landlord's insurance, you go talk to your insurance provider before you negotiate any discount on any rent. Make sure that you're not actually doing yourself a disservice in that regard. Again, there's been some APRA lending restrictions that have been lifted to try and help things with the banks in and around that regard. Now, what has been unique here is that Queensland so far has been the only state that I've noticed where they've actually given a rental grant to the tenants themselves. So this is a one-off payment where the tenant can qualify for up to 4 weeks of rent to a maximum of $2,000 in order to pay for the rent that is actually outstanding. Now, it is only 4 weeks rent and it is only a maximum of $2,000, but that is much better than nothing at all. So if you have a tenant in Queensland who's struggling to pay their rent at the moment, make sure that you actually push them towards that government grant. See whether or not they actually qualify before you try to give them any discounts. Now, I anticipate, so at the moment, no other states have actually done similar, but I anticipate that there will be other states who likely announce something similar to that in the very near term, would be my prediction. But I guess at the moment, everything's kind of a just-in-time legislation, so everyone's just trying to play catch-up at the moment. So it's really hard to tell what everyone is actually going to do and whether everyone does it in unison or not. Having said that, let's have a look at the housing market in previous downturns. So what we can see up the top, this is different incidents that have happened over time, things that have impacted our market. So Black Monday, the Asian financial crisis, the tech wreck, GFC, etc. And what you can see in blue is the housing values, and in the orange was the All Ordinaries Index. And as I indicated earlier, the stock market tends to be a lead indicator of what's actually going to happen in the property market. And the property market tends to be a little bit more sluggish in its response and doesn't tend to react as hard as the stock market actually does. If you remember one of my lives that I did a couple of weeks ago, I actually spoke to that in quite some detail to say that property markets, I think, will drop, but I don't think it's going to be anywhere near as aggressive as the stock market. And I think that the delay in that, which I'll talk to in a sec, the delay in that is caused by a number of other factors, which are really, I guess, the knock-on effect of the market dropping. Now, down the bottom, though, is probably something that we're starting to see symptoms of right now. So this is the housing volumes. So this is how many inquiries and how many actual sales. So what you'll see here is as the stock market is actually crashing, the housing volumes actually drop off and follow it quite significantly. So we're actually seeing those volumes drop right now, and that as we're seeing the stock market drop, we're actually seeing that the drop in the market inquiries as well. So this is really because of a thing called consumer sentiment. Now, consumer sentiment is how confident people are in the market. Now, people tend to lose confidence in the market when the stock market drops so dramatically. So what we can see here is in the dark line is I guess the housing prices, and then the blue line is the volumes. And what you see is they have a fairly close correlation to say, well, when the market is actually dropping, consumer sentiment drops, then the volume of transactions tends to follow that fairly quickly and fairly closely. So right now, because of what's actually happening, consumer sentiment is clearly very, very low. Now, let's have a look at the Roy Morgan weekly results with regards to consumer sentiment. Now, you can see this is the more recent time. So we had a drop in consumer sentiment because of the bushfires, and now we've had this massive drop in and around the COVID side of things. Now, there is a minor bounce back at the moment here, but whether or not that's significant or not will determine in time. But right now, that consumer sentiment is very, very low, and that's being reflected in simple things that are demonstrating this is truly the case. So this is some research that CoreLogic pull out of one of their products called RP Data. RP Data is a tool that a lot of the real estate agents use. And this is how many inquiries doing CMAs, which is a comparative market analysis. So how many real estate agents are actually doing research to see what a property is actually worth. Well, they tend to drop off when there's less people actually starting to list. And you can see that there's a massive drop in CMAs actually being occurring. And you can see even in the last 7 days, it's dropped and similar since same time last year. So the number of inquiries is dropping off very, very quickly. So we're seeing market volumes slow. Now, this is again, CoreLogic have gone out to the real estate agents and given them a survey. And the survey that they've asked them, they've actually asked the same questions a couple of weeks in a row. So what we can see, for example, here is 3 weeks in a row asking the exact same question to see whether or not the response has actually come. So the question is, do we see a downturn in the market of more than 50%? Or do we see it more than 25 to 50, et cetera, et cetera? So a lot of the agents are seeing, projecting that there's going to be a significant amount of downturn in the amount of inquiries in the market right now. So that is not a drop in price, that's the amount of inquiries with regards to, I guess, putting properties on the market. And similarly, what have we got in the regards of seller inquiries? So this is people looking for property, and these are people looking to sell property. So we're seeing a massive drop in the people number wanting to sell and a massive drop in the number of people wanting to buy. The reason is people are being very, very cautious at the moment. So volumes are dropping. Now, right now, we're not seeing those volumes drop being reflected in price drops, but we'll see whether or not that happens over time. Again, another question being asked of real estate agents is, what do they expect with regards to property values actually dropping? And the number of people that, the number of agents that are anticipating a drop of up to 20%, between 10 and 20%, and between 0 and 10%. So we're looking at 75% of real estate agents are predicting that the market is going to drop in some way, shape or form, which I think is, I guess, fairly likely that the property market will drop. But whether it drops 5%, 10%, 15 or 20, I guess time will tell, of course. So that's a little bit interesting. But what I would say is that more than 50% and closer to 60% are, when you combine these two together, are saying it's going to be somewhere between 10 and 20% drop. So whilst it hasn't dropped yet, anticipate that that may actually be the case. And then the next question is, what time frame do you expect these drops to actually occur? And it's whether or not it's going to happen. It's already happening. It's going to be in the next 1 to 3 months, or it's going to be in the next 3 to 6 months. So there's a little bit of a mixed bag as to how that's going to be. Now remember, real estate agents are not economists. They can't actually tell what's actually going on in the world. But what they do see is volumes changing inside their business. And so they're probably the front line that actually seeing what's happened in the market. So, good lead indicators of what actually may happen. So in summary, what does all this mean? Well, sales volumes have declined, but so far pricing has not yet been impacted. And I say yet, and I've got that in bold and italics because I think that is imminent, that the pricing drop is going to occur. Now, we don't yet know how much, we don't yet know for how long. So one of the things that is going to determine that is debt. So debt will be the driver of any future price drops. If people can't afford to pay their debt, then it is likely that they're going to be trying to put properties on the market in order to pay down their debt and get the debt off the table. And I guess the more amount of debt, the more people that are actually in stress on their debt, the more likely those drops are going to actually occur. So what is one of the drivers of debt then? Well, so at the moment, there are projections in the market, I should say, of between 5 to 20% price drops anticipated, depending upon which economist you're listening to and what the timelines are. Between 5 and 20% is what they're anticipating. I genuinely don't know where it's going to sit. I've got some hunches that I'm not sure that putting it on public record is something that's really going to do anyone a favor, because my opinion is no better than anyone else's opinion at this point in time. So one of the things that will drive debt, though, is unemployment. So unemployment is going to be massively the largest debt. And because of those massive job losses that I mentioned before in those unemployment rates, they're people that are not potentially not able to actually pay their rent. And so if people are unemployed and can't pay their rent, then rent's not going to get paid, which then means that landlords are then going to be under stress And so right now we've got these moratoriums that are happening on our mortgages, but depending upon how quickly those jobs can get reinstated and how quickly people can get back to actual employment and paying the rent, we just don't know how long until those landlords are actually going to start to feel the pinch themselves. And so at the moment, we've got a 6-month moratorium. So my conjecture would be that the stress for the landlords at this point in time has at least been deferred. Whether or not it's actually going to be eliminated altogether, we don't really know. But I guess the government stimulus packages that they've been released is really attempting to prop up the unemployment, and the unemployment is really in turn trying to prop up the economy. So job keeper incentives are really engaged to keep people employed, keep businesses alive, keep businesses afloat, keep businesses actually doing whatever they can in these challenging times. They've also put evictions on tenancies being banned for the next 6 months, so tenants can't actually get evicted, and interest on loans being deferred for 6 months. So what they've effectively done is really put a pause on the implications of this right now for the next little while. Now, it's not a complete stop. I want to call that out. It is really just a pause to see whether or not we can actually kickstart the economy again. Now, we don't really know, and one of the things that are going to determine whether we can kickstart the economy is how quickly we can get people back out in the workforce, because at the moment we're all in lockdown. So hence the conversation earlier, which was regarding the curve and how we've actually been able to manage the flattening of that. So my hypothesis here, and it's only a hypothesis, is the government will probably want to release the brakes on the lockdown a little bit, with the ability to put the foot on the brakes again very quickly. So they may release some areas of the lockdown in some certain kinds of businesses, for example, just to try and get people back into the workforce as quickly as possible, with a view that, if we see some spikes in the instances again of COVID, that they can then put their foot back on the brake again. So hard to tell. That's really just conjecture at this moment in time. But my hypothesis on this is that in the next 2 to 3 weeks, we're going to start to see a little bit of the easing of the lockdown for certain areas of the economy and certain business types. So watch this space on that. Having said that, the topic of today is really the implications in the banking world, but we need to understand all of what's happening behind so we can understand the implications from the banking world. So hopefully that's given a very good implication of that. So RBA, so the Reserve Bank of Australia, have been giving us a whole bunch of relief. The whole idea is they're trying to support the flow of credit. They want to keep money quickly and efficiently and give that back to business. Business is seen to be the engine room for our economy. So if we can keep business afloat with more creative business loans and easing of restrictions on the business with regards to debt at the moment, some easing that in and around there, we can keep businesses afloat is really what they're trying to say. So if small business is that engine room, so that's kind of the key. So in order to do that, there's been a whole bunch of things actually done. So RBA have got nearly $90 billion that they're going to be lending out to the banks that will allow the banks to then do these low interest loans on what is called an SME package. And I'll talk to that in a sec. But effectively, it is an unsecured loan that each of the individual banks can then go and on loan at a very low percentage rate, with the idea of trying to inject money back into everybody's business. Now, in order to do that, the government has had to change a whole bunch of legislation in and around approved deposit institutions, which are banks and smaller banks, in order to change the rules as to how they actually assess these loans, because under the very restrictive rules that we had in place before, it wouldn't have been possible for the banks to actually go and lend these out. So the government's had to say, well, not only have we got some money, but we're actually going to change the rules about how you're going to assess the money in the shorter term. So APRA is the regulatory authority that manage that, so Australian Prudential Regulatory Authority. So they're the one making the changes to all the rules right here, right now, as we go. So I mentioned an SME guarantee scheme. So right now there's about $40 billion in lending that's sitting for the banks to actually start to lend out. Now the government's making these available through individual banks up to $250,000 per borrower, and the borrower being a small business, and that can include sole traders, so long as your turnover is less than $50 million. So they're trying to do these as unsecured loans. So an unsecured loan means you don't have to have equity in another asset, and the government is actually going to back 50% of that debt. So if for some reason you can't pay it off, then 125,000 of that the government's going to write off, being that the remaining is your responsibility to actually try and do. So, so that's kind of the stimulus package that the government's trying to do into business to kickstart it. So you can be using that for different ways, to whether it be marketing or bringing clients in or keeping people employed, all those sorts of things. Now, the government has given the management of this out to the banks though. So the decision as to whether or not to extend the credit is actually going to be managed by the banks. It's deemed that the banks are the best ones to actually assess your ability to pay back that loan and actually manage the loan. So the Reserve Bank kind of gives it to your normal bank, and then your normal bank lends it to you. That's kind of how the workflow is going to work in this process. So you're still going to have to actually apply for this. Now, this is government-backed money, so the interest rates on this are going to be very, very low, and there's going to be a little bit of a moratorium on interest rates for the first little while. So the first 6 months or so, there won't be any repayments required. Instead, the interest will actually be capitalized to the end of that. So anyone that's actually interested in this, you need to approach your financial institution. What you'll find, and I'll touch on this in a couple of moments, but you need to be going to the banks that you are actually banking with right now. So those banks already know what your trading history is. They already know whether or not you're financially viable. They're the ones that are going to be making these determinations. Now is not the time to be jumping banks and seeing whether or not you can actually get this from other banks. What you'll find is that you can only do one of these loans too. So you can't go to all 4 of the big banks and try and apply for the same 250 4 times, for example. So that's going to be frowned upon as a very big no-no. Now, I mentioned before that APRA has changed some regulations that sit in and around this. So ADIs are authorised deposit-taking institutions, so that's basically a bank, or a registered financial corporation. So I guess people that are operating more in their commercial side of things. And so they've basically changed the criteria as to, well, how quickly you can approve it, what your loan-to-value ratios are, the amount of equity that you need there, I guess the assessment criteria. A whole bunch of that has been loosened up right now, including the reporting on these. Now, APRA has been very rigid in the reporting for the banks in the past, and I'm looking at this basically as us transitioning back to low doc loans. So we've got an interim period where low doc loans are going to come into play, as opposed to full doc loans that we've actually done in the past. So whether or not this stays longer term, I'm going to hypothesize no, but I guess know that in the short term, your banks are going to be looking at these kind of low doc approaches for these 250K loans. Now, the big 4 banks, because each one of them has to manage this a little bit differently, let's have a look at how so far they've managed to respond to this. Now, this is changing on a daily basis, folks. So I'm going to encourage you to make sure that whichever bank you are with, that you go and check on them as you go. But if we have a look at, hang on, I'm going to sneeze in a sec. If we have a look at Commonwealth Bank, so they've taken all of them have taken 2 different approaches for business banking and homeowners. But pretty much they've done a few things like waiving merchant fees and deferring repayments on vehicle equipment and finances and those sorts of things. So they're doing a fairly broad range of easing for expenses within your business. And they're also doing deferred repayments of a whole range of products across the board. Now, homeowners are similar in that respect, but 6-month deferral on your home loan repayments. Difference being, from a business banking perspective, businesses have extra expenses like your tap and go merchant fees and all sorts of things like that, or you may have equipment and vehicle hire. So Commonwealth Bank have tried to take a little bit broader brush on that for businesses to say, well, how can we help across the board, not just with regards to those individual loans. Similarly, Westpac have done similar, so fee-free redraws on loans, options to extend existing business loans by 3 months if they're due for expiry, a number of rate reductions, and they've also introduced the ability to get business finance counselling, which is a very interesting approach to say, well, we don't want you to actually get yourself into financial difficulty. We've actually got people that can actually counsel you as to say whether or not this is actually good or a bad idea for your business. Again, things like business loans, credit card repayments are deferred by 3 months at this point in time. And homeowners, what they've done for homeowners is to say, look, there's an initial deferral period of 3 months with an option to extend for 3 months. So rather than giving you 6 months outright, they're saying, well, let's do 3 months and then reassess. And there's also some special 12-month term deposit rates that apply in and around Westpac. Now, NAB, again, very similar approach, deferral of loan repayments. Again, 3 months in initial instances. Business and credit card deferred repayments, all those sorts of things still apply. Now, remember, all of these banks have access to that 250K process. So this is what they're doing over and above that. So homeowners, you can get a 6-month moratorium on your loans in order to pause that. But again, they're going to check in at the 3-month mark just to make sure that everything's going okay in regards to that. And they're also going to reduce your minimum monthly repayments and late fees on credit cards and things like that. So it would appear that whilst all the banks are approaching it very slightly differently, they've got a very similar theme that sits in and around that. ANZ Bank, so again, 6-month deferred repayment on loans. So straight up 6 months, where some of the others did 3 months and then defer. Temporary increase in the overdraft facilities for up to 12 months. So some people can actually get their overdrafts actually extended. They've dropped their interest rates on a number of their products, which is good to see. So even with the deferrals, they've actually dropped the rates as well, which is fantastic to see. Homeowners, again, have dropped the interest rates there, and both on their variable and also their fixed rates as well. And 6-month deferral on your loans, but again, reviewed at 3 months. So you see, it's kind of 50-50 as to whether or not you get 6 months instantly or whether you get 3 months and then 3 months again. So these guys have said, well, yes, you do get 6 months, but let's have a look at it at 3 months and make sure that everyone's doing okay. Now, if we kind of put all that into a table and map it out, this is kind of the best that I could do. I actually pulled this from BDO's table and tried to cross-reference it with some other sources just to make sure. But this is a little bit of a breakdown of what they're doing for both business and personal customers, whether or not they've actually offered interest rate relief in the short term or not, and if so, how much that's been, whether or not you get instantly the 6 months or if you get 3 months and then 3 months. So this is kind of the breakdown that I've got there. So hopefully you guys got plenty out of that little bit. Now, what I would say though, for anyone going for new loans, you are still going to have your property valued, and your valuations right now, what I'm hearing in the market, I guess quite fortunate in running quite a large network, I should say, of 8,000 odd people in our community. What I am seeing from feedback is that valuers are not technically, well, legally, they're not technically meant to predict the future, and they're only meant to be looking at historical prices. However, in saying that, they are being extraordinarily conservative at the moment, and all of their valuations, when in doubt, tend to be coming in the bottom of the range. Now, valuers always have a price range that they can come into, so high end or the low end, and depending upon the issue or challenge or the reason for the valuation, they may be at the high end or the low end, depending upon what the valuation is for. Whereas right now, what we're seeing is most of this is coming in pretty much at the low end, because they're concerned that if the market actually drops, their valuations are actually valid for 3 months. But the market is so volatile at the moment, they're concerned that it will shoot past or below their valuation mark. Now, as I said, they're not technically meant to be predicting the future. So they're only meant to look at historical price points. So if you're getting a valuation, the onus is on you to actually, I guess, hold them to, hey, there's actually a genuine sale around the corner, which is a legitimate comparable sale. Now, don't just allow them to be on the super conservative side. The onus is on you to actually challenge the valuations at this point in time and say, hey, there's a better comparable sale that you've conveniently ignored. So I want you to actually hold that valuation up. Now, they're going to be very hesitant to try and do that. So you may have to employ a third party, being a private valuer, to actually write a report to be at the higher end of the scale, so that you can actually challenge that legitimately when you're doing that. So that's the first thing, is the valuations are coming in low. Then, when you're going for new lending at banks, so when I say new lending, this is brand spanking new loan for any reason at all, whether it be a line of credit, whether it be for buying a new property, whether it be anything along those lines. So when we're looking at the banks, so currently they're inundated with the applications for those COVID-19 support packages. So those 250K unsecured loans. So their loans department has got a lot of work on happening right now. So if you're doing a new application, anticipate that loan is going to take a little while to actually get processed at this moment in time. So that's the first part. Second part is they're not looking for new business to the bank. Instead, they're wanting to only service existing customers that actually have a history with the bank. So if you're with a particular bank, then the time to jump to the next bank is not now, because most of the other banks won't want to take you on at this point in time. I say most, it's not going to be impossible, but it's going to be a little bit challenging. Instead, you're going to be sticking with a bank that you've been with for a long period of time. They can see your existing history. They know that in the good times you've been trading very, very well. Those guys are the ones that are likely to take that on. And right now, most banks are not taking on new business. They're also being a lot more conservative on their loan to value ratios. So in the past, where they've been doing loans, whether they be residential or commercial in nature, the loan to value ratio, sometimes you can get lender's mortgage insurance and that sort of thing to help protect you. Now it's starting to become a little bit more mandatory to have that lender's mortgage insurance sitting there. And also I'm seeing, particularly in the commercial space, that a loan to value ratio in a commercial sense might have been 70% loan to value before. Now it's going to be a 60% loan to value. So they're wanting to see a lot more equity in the deal. I'm anticipating that may even come into the residential space in the not too distant future. They want to see a little bit more equity sitting in the deal in case those markets drop. So watch this space on that one. Now, they're not technically meant to use the current environment to assess the loans, okay? So they're meant to say, well, let's look at the rental returns of the past and see where that goes. But in reality, what I'm seeing anecdotally is that they're taking into consideration the fact that there might be a number of rental defaults if you've got an investment property, and that a lot of people may not be able to pay in the short to medium term. So being a little bit more conservative on whether or not they assess all of that rental, or maybe 80% or maybe 70% in their assessment criteria. So be very cognizant of the fact that one, your valuation is going to come in a little bit lower, and two, when it does, the bank is going to want a little bit more LVR, and three, that they're not necessarily going to recognize all of the rent coming in. What that actually works out to be is challenging to actually get a loan across the line. Now, if we look at the private lending market, so these are high net worth individuals, or these might be pooled funds through investment funds that go into speculative property developments and things like that. So presently, these guys are looking to take risk off the table. So if they've got money out in deals right now, they're trying whatever they can to pull that money back in. So if people are paying a little bit of cash back down, and then with the intention to redraw it, they're saying, sorry, you paid it back, it's ours now, we won't necessarily allow you to redraw that. What they're really doing is they're wanting to see what deals are coming in the future. They're trying to cash up and be prepared, because they see if the market does drop, that there might be opportunities later on. Now, having said that, there are some lenders who are opportunistically seeking much larger interest rates. And so they're ratcheting their rates up to say, well, if our money is going to be out, then it's a little bit of a riskier environment right now, so we're going to ratchet our interest rates up to recognize that. And I have seen a number of instances where 30% interest rates are being offered in order to secure loans. Now, if you can make your deal stack with a 30% interest rate, that's awesome for you, but I'd be very, very cautious to say that if the market does drop, those interest rates are quite high. If it's going to take a lot longer to sell because our volumes have dropped, you're really exposed at a very high interest rate, and your holding costs are going to burn you very hard if you're not careful. Again, they're trying to be very conservative on their loan to value ratios, and a lot of them are actually asking for as low as 60% loan to value ratio right now. So, wanting more equity in the deal before they actually lend you the funds. So in summary, when you look at all of these things together, lower valuations combined with the lower loan to value ratios and conservative assessment incomes mean that getting new loans is going to be quite challenging in the current market. Okay, and if you can, you probably won't be able to borrow the same amount of money that you may have been able to 6 months ago. Banks are typically only wanting to deal with existing customers with a known track record. So where you've been banking with them for a very long time. Doesn't necessarily mean that you've had a loan with them before, but at least that you've been transacting with them for quite some time, and they can actually see your income and expenditure going in and out of your bank account on a regular basis. So that said, my predictions for the next few weeks, folks, I'm going to say, and again, I'm not an economist. I don't want anyone here to be taking action on this. This is really just an opinion. You really need to seek professional advice for your own personal circumstances. But what do I see? I see in the next little while, private lenders for small scale developments, I'm going to say those are going to start to dry up in the short little while. I'm going to say volumes of transactions on properties in the next little while, one, they have dropped, but two, you're going to start to see price reductions. And so if you have a requirement for selling a property right now, I'd be looking at getting that on the market right this very second, before people start to get into distress and they start fire sailing. So when they start fire sailing, then there's going to be deals happening everywhere. And if you're trying to hold your price point up, it's going to be very difficult for you to achieve that. So if you need to sell, then the time to list is probably now. If you don't need to sell, I would be probably sitting on my hands for the next little while, for at least 3, maybe 6 months, just to see what actually happens. Remember, property is, I guess, has 2 different cycles. So one is long-term buy and hold, in which case you could ride that market out and it'll come out the other side if you can hold on to it and afford to hold on to it long enough. Or 2, it's very transactional if you're trying to do developments and flip. So you need to make a very clear and conscious decision to say, well, why did I buy this property in the first place? Is it actually serving my goal? Right now, where am I physically sitting with regards to that transaction? Could or should I be transacting that at this point in time, or should I actually ride the market? They're the decisions that you should be starting to make right now. I would not be waiting 3 months or 6 months to make those decisions. I'd be making those right this very second. other things that I'd say, I'm going to say, for me, my prediction is in the next 3 to 4 weeks, I don't think we're going to see any significant price drops in the property market. But I think the next time we do one of these assessments, my view on that may change based on whether or not the stimulus packages are actually starting to come into play, based on whether or not they release us from this lockdown and some of us can actually go back to work and get the economy back moving again. So right now I'm alert but not alarmed to say that there's potential that our property market could drop, but I don't think it's in the next couple of weeks. I think it's going to be maybe a month or so from now, but I don't know, is it going to drop 5%, 10%, 15 or 20? And I also don't know how long that recovery is. But what I would say is, based on history, the lag between the stock market and also the property prices is significant enough to say we've probably got a little bit of time right this very second, but not a huge amount. And the drop is probably not going to be anywhere near as significant as the stock market is if history has been any indicator. So that's me rubbing my crystal ball. I just don't know whether or not that's going to play out. So, but each week I'm going to be doing these market updates, and specifically, I run. Many of you would know we actually run meetup groups that we used to do in the physical world, but now we're running them as virtual meetups. So these virtual meetups, if you want to get involved in these, I actually do a market update every single week when we're running these, so we actually get up to minute exactly what's happening right here, right now. We also have industry experts that are regional, so we run a Brisbane event, we run a Sydney event, and we run a Melbourne event. So you get industry experts based on your individual region. That's going to help you to understand issues and challenges in that particular industry. We also have people from our community actually sharing real deals, so you get to see the good, the bad, and the ugly of a deal, and can see exactly what's going on there. And lastly, we have a masterminding session. So the masterminding session is really intended to try and help you resolve whatever your current issue or challenge is right now. And in the current market, we're seeing this masterminding session very, very valuable, because there are lots of things that are popping up that are very unusual. And so we're getting the collective experience of the community trying to help you through that. So I will give you a link to this in a moment as to how you can actually get involved in that. Just allow me momentarily to see if I can see what's happening with the questions that are coming through. And I'll give you a link to that. And also, so if any questions coming through on that would be fantastic. Let me just see what's actually coming through questions-wise. I cannot see my live on Facebook, so I can't see any questions coming through. This is 2 weeks in a row that this has actually occurred to me. Let me just see whether or not others, there we go, others are actually commenting on it. So no. I cannot see what's going on. I can't see any questions coming through, folks, which means that either I've pressed the wrong button and I didn't go live, or I, once again, haven't worked out how Zoom interacts with Facebook, which is very, very challenging on my behalf. I've tried 2 weeks in a row to get this to work, and let's just see if I can find a couple of links that are going to help people to find what's going on. Please hold while I navigate around my Facebook community. No, I cannot see it. I don't know what's going on. Damn, that's 2 weeks in a row that I've stuffed that up. So, let me see if it's appeared somewhere else. No, I either haven't gone live or I'm in a world of pain. So, folks, as much as I would love to take questions this very moment, it doesn't look like I'm actually able to. So, yeah, really disappointed at that. Hopefully hopefully the live has gone through and I just can't see the questions. So, once the post does go live, I know that I've actually recorded this content, so I will actually, if for some reason the live didn't happen, I've actually done hit record on this, so we will be able to at least post it on a Facebook page, and I'll try to respond to any questions or comments that come in there over the next hour or so. Thank you, folks. Really appreciate the update. Would love to see you at our next virtual meetup, and I'll put the links for that in the comments below. So thank you, folks. I will see you all on the flip side. Ciao, folks.